you, sir. Good evening to all. This is Vishwas, digital marketing expert from RERA Consultants LLP. I welcome you all for the webinar on GST series for real estate. Today's topic is RCM applicability on unregistered purchases. I am honored to welcome our speakers for the day, CA Venugopal sir, CA Rajesh sir, CA Ashika madam. Let me start by introducing our first speaker for the day, CA Venugopal sir. He is a founder partner in Venu and Vinay Chartered Account since 2002, with academic credentials which include securing all India 45th rank in CA final. He is also certified information system auditor and has completed various other certificate courses from ICAI, namely DISM, course from business valuation, course from internal audit, course on fraud detection and forensic accounting. He has completed a one-year course from IIM on data analysis and business intelligence. He has authored various industry-specific handbooks on GST. He has contributed to the technical guide on GST audit released by ICAI other publication materials. He has developed a lot of Excel-based free utilities on GSTs like JSON Reader, creating JSON files, GST Invalidator, composition versus regular benefit analysis, GST Impact Reader, real estate projects with decision analysis, GST audit working paper tool, and many more. He is a GST faculty for ICAI and conducted various workshops and webinars. Apart from audits, he has hands-on coding in Visual Basics, .NET, Python. He also reviews database design. He conducted various workshops for corporates on use of technology, improve efficiency at work using Excel, building automated reports from accounting and financial applications. He is the man behind the development and managing of cloud applications like TaxSmile, Insta Financials, and many more. Now I am honored to introduce another speaker of the day, Ashika madam. She is a current holding the position Senior Manager GST at Venu and Vinay Chartered Accounts. Having achieved Chartered Accountancy in 2013, she has dedicated her professional journey to the indirect realm of indirect taxation. She has comprehensive exposure to the GST ranging from examination of taxability compliances verification, adjudication, and appeal and representation at all levels. In addition, she has been an active participant, actively contributing her insight to the various decisions and topics surrounding GST. Today, from these experts, let us learn more about detailed understanding of 8:20 rule, project to which the rule do not apply, procedure and timelines to make payment of taxes, common errors or exclusion in expenses calculation. Now I request Venu sir to take over from here.
Thank you, Vishwas. Vishwas, you have to enable screen sharing for me. And is the session recorded? Some of the times people ask for the recording of the session. Whether Pradeep, Resha, can anyone enable the screen sharing for me? Yeah. Okay, great.
Payment చేసిండే పంపించేవాడు అదే రాసలేదు.
Yeah. Again, request to mute others so that there is no disturbance. All right. So participants, welcome you all for the monthly GST session on the real estate series, and special thanks to the RERA Consultants LLP, Narita chapter, and OPAZA for bringing out these knowledge sharing sessions. And today's topic is understanding the reverse charge mechanism in case of unregistered purchases in a real estate project. So what I'm going to cover is what are the notifications that have been issued in this regard, to whom this is applicable, to whom it is not applicable, how do we compute this practically, and some of the FAQs issued by the ICA, by the CBIC, and the practical challenges and the Q&A. Feel free to put your questions in the chat, and at the end, we'll also have, you can unmute yourself and ask the questions. All right, so starting with the notification relevant to this is notification 7/2019. And the section 9 subsection 4 got amended after the second year. The Finance Act has amended, saying that a class of people, a specified class of people whom are notified, only to them, unregistered purchases, the recipient, that is the buyer of the goods, have to pay GST on a reverse charge basis. Prior to that, this notification was applicable to every dealer, every unregistered purchase. So there was a notification 8/2017 where they have given an exemption up to 5,000 rupees. Then it went into a lot of litigations. In 13th October 2017, they have endlessly withdrawn this thing. But after the act got amended and said a specified class of people, and after the amendment of that, no one was notified. And the first notification came up on 30th March 2019. A series of notifications came for real estate. So notification 7 has been issued, saying that if the category of the supply of goods or services where it is given to the real estate promoter, so the recipient of the goods or services is given to the promoter. So they have also defined who the promoter is. The promoter is also defined, and they have said the promoter here is all linked to the definition 2ZK, the RERA, where they said the promoter is someone who is causing for the development of the project. So everything is linked to RERA. And after this notification, agreed that, okay, there is a reverse charge applicability. We also now need to know the classification rate of tax. So they have also issued simultaneously the rate notification. So here they have said for the goods, any goods or services which constitute the shortfall of 80%, that is first RCM entry. Second, cement falling in a chapter heading 25-23. So there is no threshold limit. Third, capital goods. So they have bifurcated the unregistered purchases into 3 categories: input goods and services other than cement and capital goods. So for input goods and services other than cement and capital goods, they have capped 80%. That means out of total purchases of rupees 100, it is expected 80 rupees has to be from a registered vendor. Let's say if the purchase from registered vendor is 75 out of a project consisting of 100 crores, 75 crores was from registered vendors, 25 crores from unregistered vendors. From the total project cost, please note I'm talking about total project cost, which means steel, cement, labor, everything 100 crores. My registered vendor purchase is 75 crores. So there is a shortfall of 5 crores. That 5 crores is intended to be taxed here. However, there is no limit for cement and the capital goods. This is something one has to be very careful of. Now, what is the rate of tax for this? So this goods has been defined under serial number 452Q. It can fall in any chapter, whether it would be in 0%, 5%, 12%, 18%, 28%. Irrespective of it, it can fall in any chapter. The supply of any goods other than capital goods and cement, the rate of tax has been mentioned as 9% CGST, 9% SGST. That means 18% is the rate of tax where the developer, the builder, has to pay to the government. This is for goods. So what about services? So services have also been mentioned in the 3/2019, where in the chapter 99, they have said the supply of services other than, so they have excluded TDR, lease, premium, everything, by an unregistered person to a promoter, where the project on which the tax is payable under 9(4), again there it has been mentioned as 18%. So that means in both the cases, both for goods and services, rate of tax is defined. Value is your purchases, the time of supply, the time at which you have purchased, you will have to pay this. When do I need to do this? How do we do the computation mechanism? So the computation mechanism is given as year on year, project by project. The computation mechanism is year on year and project by project, the taxes have to be paid. Now let's look at what does that mean. So I've given some simple steps. So divided into 6 steps. Firstly, out of the total purchases, you identify the purchases belongs to input and input service. I is input, IS is input services. So segregate cement, segregate capital goods. Then look at the vendor, whether vendor is registered or not. Third, see whether this has been used for supplying the services, where is it used? Because if you look at again the notification, the wording used in the notification is supply of goods and services which constitute the shortfall from the minimum value of the goods and services required to be purchased by a promoter for construction of the project in a financial year. In a financial year or part thereof till the issuance of completion certificate. So the words which are very important here is which are required to be purchased by a promoter for a construction of the project in a financial year. So this is what which has been given. So if we look at it, whether used in supply of services, that is what you have to see. Then you apply 80-22 rule, which will give a calculation. We'll go step by step and discharge the tax, which is unregistered purchase beyond 20%. And this has to be done project wise, financial year wise, GSTN wise. So this has to be done project wise, financial year wise, and GSTN wise. Now let's look at the next step. Let's look at the next step. All right. I'm unable to change the screen. Let me share the.
Sir, any help?
1 minute, yeah.
Really?
All right. So let's look at the steps. Step 1, identification of input and input services. So in the computation, the capital goods are excluded. Cement is also excluded. But for the purpose, I'll say you need to know the P&L because capital goods are in the balance sheet. So take the total P&L. Now, for cement, irrespective of the shortfall, you have to pay 100%. We'll see by way of example. So pay the RCM for cement. Pay the RCM for cement. The moment you pay it under RCM, it would automatically become as a registered purchase. It would automatically become as a registered purchase. Then for the other inputs, which is other goods, include in the calculation and do the computation for discharge on a yearly basis. Services, whether or not you capitalize services, all services would be included. Popular question comes, what about salaries? Is it input or input services? Salaries is a schedule 3 item. So it is neither goods or services. So it has to be excluded for the computation. So in the 100 crores, that example that I have mentioned in the project, so 100 crores, you have to exclude the salaries from the total computation, then apply 80-20 rule. Let's say out of the project 100 crores, 75 crores is from unregistered vendor. So I said 25 is what you have, 75 is from registered vendor and 25 is from unregistered vendor. So you have a shortfall of 5% is what I have said. But exclude your salary. Let's say 10 crores is the salary. That means 75 over 90 and 75 is not over 100. So when you apply this formula of 75 over 90, then it would be 83%. 75 over 90 is 83%. That means you are meeting the threshold. So for computation of the threshold, you have to exclude the salaries and other things. Now, certain things which you should be further excluding, which I've said while I was talking about services, is the development rate, the TDR that you have purchased, additional TDR that you have purchased, lease payments, electricity, high-speed diesel, motor spirit, the petrol. So these have been specifically mentioned in the notification for exclusion. So this has to be excluded. So the notification 3/2019, they have clearly said these items have to be excluded. So FSI and motor spirit, all these have to be excluded. 9(2) sub purchases, these have to be excluded, right? So let's look at the step 2, which is identification of the supplier. Now, when we look at identification of the supplier, so you have to treat firstly every purchase, whether is purchased from a registered dealer or unregistered dealer. So when we say registered dealer or unregistered dealer, what we are saying, it is not that you have to see whether the taxes have been paid or not. In case of an exempted goods, there is no tax, but you have to see whether that has been purchased from a registered dealer or unregistered dealer. So you have to look at where have been purchased. Now, unregistered dealer, whether his turnover is below the threshold limit, he might not be engaged in business of supply of goods or services, or he is exclusively in RCM, but he is unregistered. For whatsoever reason, he is unregistered. Sometimes someone whose registration has been cancelled with retrospective effect. So should we treat this as registered or unregistered? In my view, if you are purchasing from someone at that point in time, if they have a valid registration, it is a registered purchase and not an unregistered purchase. This is something you have to be very mindful of, because you cannot take a transaction post facto. Let's look at the approach, how you have to do. So the total expenditure in the P&L, let's say 100, eliminate payroll, eliminate depreciation, eliminate 9(2). So when you eliminate all this from 100 rupees, I am eliminating totally 40 rupees, 12, 10, 18. That means input services goods used for the project is 60. So the 60 is now becoming as a 100% base. 80% of 60, 80% of 60 is 48 is what you will have to procure from the registered dealer. Let's say the purchases from the registered dealer is only 40. That means shortfall is 20. Should you pay the GST at the rate of 18% for the 20? The answer is no. Since the shortfall is 8 rupees or 8 crores, whatever be the factor, on the 8, you would be paying at the rate of 18%. You would be paying at the rate of 18%. Now, why am I taking 2A as basis? Why don't you take your 3B? There could be someone who have not reported R1 or something. I'm just taking for the ease, for practical approach, I'm taking the 2A, but you can go ahead from whatever which is there in the purchase register as a registered purchase also. Even that should be fine. I don't see any issue there. Let's see some of the examples. I've given the first simple example. Out of 100 rupees purchase, sand 100, cement 15, steel 20, it's totaling to 100. Just focus on the last column, whether you have purchased from the registered person or unregistered person, right? If you look at it, all items have been purchased from a registered dealer except cement, Now, how much you have purchased from the registered dealer? 100 minus 15. That means 85 rupees you have purchased from the registered dealer. Question is 80-20 rule applicable? Do I need to pay any RCM for unregistered purchase? Theoretically, people will say no, but unfortunately, the answer is yes. Even though URP is 15%, you still have to pay RCM, because cement, there is no threshold limit. On the cement, you pay RCM on 15 at the rate of 28% because cement is at 28%. So here the 80-20 rule doesn't come into place. Moving to example number 2. Let's say in an example number 2, my cement is fully purchased from a registered dealer because you can see on the right side the 15 is marked as yes. But let's say paint 5 is purchased from an unregistered dealer, aluminum 15 is purchased from an unregistered dealer. That means my URP purchase is 20%. Do I need to pay on this 20 rupees at the rate of 18? The answer is no, because there is no cement, there is no unregistered purchases. Since it is not a cement, you will be applying 80-20 rule. So 80% of the purchases are registered dealer. Hence, you don't need to pay GST on unregistered purchase in this example. Let's go to the third example. Now, in the case of a third example, you can see sand at 10 from an unregistered dealer, cement 15 from unregistered dealer, aluminum ply is from unregistered dealer. So out of 100, you have 10, 15, 25 and 30, 40, you have totally out of so much the purchases, 40 is unregistered purchases. Now, what is that you are going to do? Cement 15 is in the order of the priority is what you will be paying GST in the first place. You will be paying cement for the 15 on 15 rupees you will be paying. The moment you pay GST on 15 to the cement, so what happens? The first line item which is cement, you have paid it off. So this will become from unregistered to registered. So you will be paying 15 at the rate of 28%. You will be paying 15 at the rate of 28%. Now, what is the unregistered thing? So 15 plus 5, 20 plus 10, 30 is the unregistered. So so since you have already paid, so out of 100, 70 is unregistered. That means you have a shortfall of 10. You have a shortfall of 10. It really doesn't matter whether this shortfall is in this pool, which is of 12%, 18%, or whether it is in this pool, which is of 5%. It doesn't matter. The whole of 10%, whole of 10 would be paid at the rate of 18%. Whole of the 10 would be paid at the rate of 18%. So in the given example, you can see the cement 15 rupees is paid at 28%, and the rest of the items are paid at 18%. So the 10 is paid at 18%. This is how the computation has to happen. So you've seen 3 different examples how it has to happen. Now, important aspect is all these items which I have given, if you look at it, I have given the expenditure which is relating to the construction. So you also have to see what are the expenditure I have to look. The input and input services, the words used in the act, are the input and input services which are used by the promoter, are required to be purchased by the promoter for construction of the project. So any expenditure that is required for construction of the project would be forming part of it. So it has to be necessarily be used in construction of the project. Hence, it is very important that some expenditure which has got nothing to do with the construction. It is an entity level purchase. Say business has purchased one car. Doesn't really matter for this thing. Capital goods on capital car from an unregistered dealer. Hypothetically, I'm giving. Okay, let's say a computer or something, some sweets from some shop to the staff. So these which are not relating to the construction cannot be forming part of this computation. So what is necessary? That means you have to maintain project-wise accounting is necessary, so that you can discharge these taxes. So you have to look at it, something which is directly related to the construction. So construction cost is something which is related to the construction, either directly or indirectly, but it should be forming part of the construction. That is something you have to be very careful. Something relating to the construction is only the thing which you will be taking. Let's say the total cost of the project 10 crores. Something to the business activity, which is head office expenditure 2 crores. You eliminate the 2 crores. So what do you include for the computation of 80-20 rule is only the construction related cost, which is that 8 crores. Whether it could be a direct expense or indirect expense, directly related getting into construction or indirectly getting into the construction, but it has to be included in the computation of 80-20 rule. Now, the next question comes is whether something which is exempt, would it still be forming part? Or something rate of tax is lower, would it still be forming part? Let's say sand, river sand is either exempt or at 5% is taxable. Water, not taxable. All jelly, marlu, everything is at 5%. So when these things are at lower rate of tax or not taxable, do we need to include it in the forming part of 80-20 rule? The answer is yes. That means a developer, as an accountant, we definitely needs to advise to the promoter saying that anything that is lower rate of tax, you make sure you buy it from a registered dealer, including the exempted goods, buy it from a registered dealer, else it would become a costly, which otherwise you are paying 5%, now you are going to pay at 18%. So as a part of the tax optimization or tax planning, this is the advice that you need to give. Ensure procurement have to be done from a registered dealer. Now, what happens to the composition purchases? Composition dealer charges money, but he doesn't collect any tax, nor I pay any tax to him. Would it be forming part of it? Answer is no. The 80-20 rule deal says that purchase from a registered dealer. Even composition dealer is a registered dealer. So composition for goods which otherwise they pay a tax at the rate of 1%, traders, or in case of services they pay at 6%. It is better you buy the goods or services from the composition dealer so that you are bettering your tax position. Now, what happens to the 9(3) services? There are some specified services, 9 subsection 3. Now, does it forming part of 80-20 rule? Again, the answer is no. If something covered under 9 subsection 3, it is a specific entry. It has been notified and it's a specific entry. Anything which is specific, 9(4) is kind of general. So you will be paying tax on this whether you purchase from a registered person or an unregistered person. Let's say GTA services, lawyer services, sponsorship services, or registration licenses, procurement from the state government, central government. These services, when you are buying from someone, you are responsible to pay GST. So 80-20 rule would not be applicable here. So 9(3) services are specifically covered. Whether you are buying from 9(3) or 9(4), you have to ensure that 9(3) have to be paid. I'll give you a simple example. My total project cost is 100, of which 95 is from registered dealer, 5 is from unregistered dealer. What does this 5 comprises of? Let's say lawyer fees, sponsorship service, government, or motor vehicle renting. Now, in these cases, whether he is registered, unregistered, doesn't matter. These 5 rupees fits under 9 subsection 3. Hence, you have to mandatorily discharge the tax under 9 subsection 3 and do not correlate with the 9 subsection 4. This is an important thing. Then this has to be done project by project, year over year. 80-20 is applicable for the expenses of that year. Let's say I am incurring 100 rupees in year 1, 100 rupees in year 2, 100 rupees in year 1, 100 rupees in year 2. In year 1 for the 100 rupees, 100 out of 100 are from registered purchase. Year 2, out of 100, let's say out of 100, 70 is from registered, 30 is unregistered. 70 is registered, 30 is unregistered. But the end of the year 2, how much is the total cost I have incurred? I have incurred 200. Of 200, 170 is from the registered dealer, because 100 in the first year, 70 in the second year. What's the percentage of 170 over 200? Because we are expected to maintain 80% the regular thing. Now, 170 over 200 is 85%. 170 over 200 is 85%. Having spent 85% from the registered person, should I need to pay RCM for the shortfall? Answer is yes. Even though it is 170, you will be paying 10 rupees under reverse charge. Why is so? Because in year 2, out of 100 rupees purchase, 70 was from the registered dealer, 30 is unregistered dealer. You are expected to do this. You are expected to do this computation every year and not on a YTD basis, not at the end of the project. It is not on a YTD basis. Next, do I need to do every project wise or the entity wise? Let's say the example that we have taken year 1, year 2, I will say project 1, 100, project 2, 100. In project 1, I have spent 100 out of 100 registered. In project 2, I have spent 70 out of 100 unregistered, same year. So in the same year, if you look at it, out of 200 rupees cost, 170 has been purchased from a registered, which is 85%. Do I need to still pay under RCM 94? The answer is yes. So it is not entity, it is not qua entity, it is not qua project YTD. It is per project, per year is what one have to look at it. Now, if you look at year 3, I have obtained OC. I have obtained OC. Again, even year 3, when the OC has been obtained, the RCM of 94 has to be checked. Till when? Till the date of OC. The expenditure that is incurred till the date of OC, you will have to check this. Year 4, OC has been obtained, but I'm still doing some maintenance and other like external some activities or leftover things. After obtaining OC, any expenditure that you are incurring would not fit into that 80-20 rule. 80-20 rule is applicable only till the date that you have obtained the OC is when you will be using the 80-20 rule. Hope this example is clear, and please put your questions in the chat. I'm going to take it once we complete whole of the session. But I would also bring your attention to some of the FAQs that have been issued by the CBIC. Like first one, and these FAQs are very important because it would also, though this is not a circular, not a notification, not binding, but gives a cue of whenever we say intent of the lawmaker, these FAQs can be read in that way. So if the value of the purchases has been prescribed by a registered supplier is less than 80%, what would be the rate of tax? They've clearly said the rate of tax is 18%. Now, to the extent of shortfall of 80%, which will not cover cement, because for cement, the applicable rate 28% has to be dealt with. Second FAQ, in case if 5% and 1%, the affordable and other than affordable 5%, whether the conditions of payment of tax through cash ledger, the payment of tax under RCM subject to 80%, I am not availing input tax credit, I'm reversing it. Do I need to maintain the project-wise account, report that IT taxes have been paid and ITC has not been availed? The answer is yes. You have to do this project by project, and you cannot take ITC of the payment that you have made under 94 Lastly, this payment has to be done in cash and not using the input tax credit. The next FAQ is, are there exclusions in my computation? The exclusions are your salary, because salary is a Schedule 3 supply. Hence, the total purchase of 100 will not, the total P&L of the 100 will not include salary. If you have to go back to the example that we have seen in terms of computation, in terms of computation, how do we do the computation in the P&L? We have seen in the step 2, from the total P&L, we have reduced the payroll cost. So the 80/40 is applied to the balance amount. Let's come back to our FAQs. Now, is this applicable for a commercial project? Is 80/20 applicable for the commercial project? See, the 80/20 rule is applicable for an RREP project. It's an applicable for an RREP project. Commercial is an REP project. 80/20 rule is not applicable there. But what happens to mixed project? Let's say 60% of it is residential, 40% is commercial. So how do I test 80/20 rule and how do I compute the 80/20 rule? So the total purchases, the steel, cement, everything required for the project which has been purchased, everything you still have to do in the ratio of the carpet area, in the ratio of the carpet area of residential and commercial. The ratio of the carpet area of residential and commercial. For the residential portion, you will be testing this 80/20 and then discharging the additional amount for the residential portion alone. So the wordings again, where is this applicable? This is applicable for an RREP project. So where in the notification 3, they have clearly said that this is applicable for an RREP project. So you have the entry in 3/2019, where the condition has been given is for other than commercial projects. This condition has been given. What about the old projects who have not migrated to the new rule? So the old project had annexure for filing, and you can continue to be in that 12% or 18% effective rate. So if someone continuing in the old project, then this doesn't apply. This 80/20 rule is not applicable for those which are there in the old project. What about exempted goods? I purchased water, or I have taken loan, I am paying interest on the loan. So when I'm buying these exempted goods and services, do I need to treat this under 80/20 rule? The answer is yes. Inward supplies of exempted goods and services will also be included in computing the 80/20 rule. You may also say, how can you tax this? This is otherwise exempt. If something which is otherwise exempt, how one can tax under 80 in the name of 80/20 rule? How come a water will become 18% rate of tax? This is absurd. Someone has gone mad in drafting the notification. You may say it, but today that is the law of the land. If you are not happy with it, you have to contest. You go to the court, contest it. But for the purpose of compliance, you have to comply this rule as given. Then I am also buying the land for some for the purpose of some FSI, or I buy TDRs. Does this need to be included? So these are Schedule 3 entry, so not to be included. The TDR, lease, long-term lease, FSI are not required to be included in the computation of 80/20 rules. So these are some of the FAQs which have been given by the CBIC. Now let's look at the practical issues that will come up while complying with this, and what are the resolutions, or how do we see it. First, the goods are purchased from the registered dealer, but they did not get uploaded in 2A or 2B. Recipient GST number is also not there in the invoice. So Let's say I am ABC developers, I have purchased from the registered dealer, but my registration number is not mentioned. So for him, it has been treated as a B2C, hence not there in 2A, 2B. So do I treat this as a registered purchase or unregistered purchase? And the answer is, it is a registered purchase. So you will have to treat it as a part of the registered and not unregistered. Interest on loan which has been taken from friends and family who are not registered, would it be included in the 80% category? The answer is yes. So any expenditure incurred for the construction of the project which is otherwise required, so these funds are for the project, it also has to be included in the 80-20 rule. What about the TDR certificates purchased, additional TDRs taken to raise the FSI? These would not be included. Tax is otherwise payable under 9(3), which is not paid. What do I do? Tax payable under 9(3) has to be paid under 9(3). It has to be paid under 9(3). And after you make the tax under 9(3), it would then become as a registered purchase. Next, the project is over 3 years. First year, no shortfall. Year 2, shortfall of 80%, and year 3, no shortfall. And overall project, if I see, there is no shortfall. So do I still need to pay? The answer is yes. You are looking at year over year. Hence, year 1 and year 3 are exempted. Year 2, you have to pay. Even though overall project do not have the shortfall, you still have to pay under RCM. Does 80% would include head office expense? If yes, how to allocate? And what about ISD and cross charge, which is not done to the parallel project? So if you look at again the notification, the words used in the notification are the expenditure required by the promoter, the expenditure which is required by the promoter for the construction of the project. So anything which is required by the promoter for the construction of the project would be included, it would be included. Other than that is what it will not be included. Kind of head office expenditure would not be forming part of computing 80-20 rule. I have an excess material lying in site 1, which I have transferred to site 2 and 3. How do I include this in 80-20 rule? So when you procured the materials and that are not being used, so this is where the accounting is expected to be done project wise. So the accounting is expected to be done project wise. You will have to transfer this cost to project 2 and project 3. So I might have a single purchase bill of, let's say, steel of 10 lakh rupees that you have to allocate 5 lakhs in project 1, 2 lakhs in project 2, 3 lakhs in project 3. Like that, you will be segregating and then you compute. So the material moving from one side to other side is also included in 80% computation. What do you mean by expenditure? Is it something which has been booked in the books, or does it mean something which has been paid? How do I go? Because nothing has been defined in the GST law, you will have to go the way you are maintaining the books of account. Some maintain cash basis, some maintain accrual basis. The basis you are maintaining the books of accounts, that's how you will go. Technically speaking, you will have to go basis the time of supply given under section 12 and 13. So for the unregistered purchases, whatever is the time of supply, wherein services is 60 days, goods 30 days from the date of entry, from the date of the making of the payment. So going by those, you will have to treat whether for the year means what does it include. Something which has been transitioned to GST from old regime, so to 5% regime. Do I need to make any attention to the past purchase? Is this computation of 80% do I need to do for the old year? Let's say project has been started in 2018, April 18. April 19, I have moved to new regime. When I move to the new regime, do I need to check the 80-20 shortfall of the previous year? Answer is no, I don't need to check. Then there are entries in the books of accounts where it is done only for the purpose of Ind AS adjustment, whether it is lease equalization, IFRS, Ind AS. These entries which have been posted in the books, do I need to include? The answer is no. I have said anything which has been like adjustment, book adjustment, that has to be eliminated, and then you have to see. like depreciation we have eliminated. What happens in case of a redevelopment of a halted project? And let's say the project is taken over by the LRTs Association. Do they need to check this compliance? Again, the answer is yes. Even if it is LRTs Association, they have to check the compliances. If a project is under old project, continued with ITC in the new regime, for that, is it applicable? The answer is no, it is not applicable. Landowner needs to be concerned anything of this clause? The answer is no. Here, the concern is of the developer promoter and not the landowner promoter. What happens to the commercial apartments? The condition of 80-20 is there for the residential apartments. So commercial apartments need not be worried. And in any case, they get an input tax credit. The government was more worried because there is no ITC. Would the builders resort to a mechanism where there would be unregistered purchase? That is where they have done. In fact, after this entry, there has been a substantial revenue collection to the GST, to the government from this sector. In an REP project where 70% residential, 30% commercial, how do I deal with this? Here, 30% which is commercial is not applicable. So assuming this is a carpet area, expenditure you have to split into the same ratio. Then on the 70%, you will apply the 80-20 rule. Then for the shortfall to the extent of the RREP or the residential portion, you will be doing this computation. What about the wages that have been paid to the daily laborer who are not on the rolls of the company? So whenever there are payments made to the daily laborers who are not on the rolls, but they are wages, weekly or a daily labor, would you treat them as a Schedule 3 entry as a salary and exclude? The answer is no. These payment made to the wages to the daily laborers should also be treated as an exempt or unregistered purchase and to be participated in that 80-20 rule, and GST is applicable on this. So these are the various FAQs. In fact, Rajesh was supposed to join. He is in department. Both Ashika and Rajesh should join in any moment. I forgot to announce it. If they join, any technical questions that are there, we can also have Rajesh sir answer the question. And those who are not part of our GST daily updates, you can scan this the thing and you can be part of our daily updates group. So friends, these are the various points that you need to consider, because in a residential project which is otherwise the GST input tax credit is not there, most of the developers thinks that okay, if I pay 5% on the total units I've constructed, is my liability over? The answer is no. Apart from that, you also have to check this. Hence, let us you look at this compliances also and make the payment of the taxes. With this, I've come to the end of my presentation. Now, the floor is open for questions. You can unmute yourself and ask any question that you have. Anyone, any question? You can put your question in the chat or you can unmute and ask. All right, so there seems to be no question. So we are well within the time. It's 4:50. We can conclude. Over to you, Vishwas and Pradeep.
Thank you. Thank you, sir. Dear participants, thank you for active participants, and special thanks to our speakers for giving us their valuable time and insight on today's topic. Hope the session was informative and knowledgeable. If you have any queries, please do contact us. Thank you and have a great evening. Thank you.